live from New York and London, England, where it's about the same temperature. Stephen Whiting and David Balin talking a little bit about wise strategies for markets in turmoil. And the turmoil is caused by artificial intelligence. We'll have a special guest spotlight today, our first of our New The Point series called Software in the Spotlight. But Stephen, as we take a look at the news of the week, a lot going on in markets, right? Some big elections in Japan, et cetera. But the big news, right, was a sector sell-off in software. Say that 3 times. We basically saw a 20% decline in software prices, a bounce back. We'll be talking a little bit about that. But behind all of that, of course, is a 34% year-over-year gain in software spending on AI, which Stephen will talk about. We have changed our asset allocation bigly. And we've added MLPs, and we've added some mortgage REITs. Those are very high-yielding things, but we've taken out aerospace, defense equities, a little bit of other things to make room for them. We'll talk about that. Japan has elected its first female prime minister, which is great. And what we'll talk a little bit about is what's going to happen with their expansionary policies, which will be different. Global markets are bouncing back from a lot of political events that Stephen will talk about. And Stephen, I'll let you deal this with last one because it's your favorite. Little chat about U.S. employment. What was the news?
A lot going on in the data, a lot to mislead. The January employment report was much stronger than really weak expectations. We bounced back 130,000 jobs in the month of January. One of the things that we're going to talk about is January employment data are mostly seasonal adjustment. The actual decline in employment was 2.65 million people. We call that plus 130,000. Now, what happens every January in the United States is that there is seasonal hiring, some of it just literally for the Christmas holiday, and that drops out in January. But because the seasonality of the Christmas holiday has been getting less and less, we hire fewer people, we end up cutting fewer of them. Again, on those temporary seasonal layoffs, it shows a bigger bounce. So this is just one distortion. The real big news is that we've taken the gain in employment for 2025 from a meager 49,000 per month to an even more meager 15,000 per month with downward revisions for the year. So there's a lot to think about here. We've been looking back at 2025 as not a good year for the economy away from AI. And one of the things that we'll talk about is another 54% gain in AI-related capital investment is expected for 2026. So that's been really powering the growth of the economy, which was about 3% for the full year, but very little else to drive up employment. Now, we're going to talk about what that means next. We've been looking for a better economy, but helps a little bit because the backward look wasn't quite so good.
Right.
So
which is another way to
say
that sometimes when the rearview mirror gets worse, it makes the current mirror look good, which we're going to talk about.
It raises possibilities. I'm going to make one correction. The weather here is much better in London than New York.
Okay, well, thank you for that, because we never want to give you inaccurate news. Let's move ahead on our slides, please. So this was, for us, a software having a deep seek moment. Now, for those of you who may recall, just a year and change ago, there was an announcement of a less expensive and supposedly highly efficient Chinese AI model that caused all of the stock market to take a deep breath briefly, and everything sold off. This sell-off looks similar, Stephen. What was really interesting about it was that all of a sudden, people had this idea in one day that the degree of CapEx that was taking place in AI was going to have a profound impact on the future earnings of software, which is going to be the special segment for today. But if you take a look at that decline, and you've pointed this out before, relative to the extraordinary performance of AI, could it actually be true that in one day you could lose 20% of the value of an entire industry due to the technology that hasn't actually had its biggest impact yet?
So Abe Wan is going to talk a little bit about the speculation and what actually caused this, and I don't want to steal his thunder completely. But the thing about DeepSeek was this notion that we would be able to use microprocessors better, so therefore we wouldn't sell them. So NVIDIA chips sales were going to fall. But the better use of chips and processing for AI to make AI more effectively just creates more demand for AI chips. Now, I'm not saying that this is going to be the exact same thing, but we do look at this decline that we've seen in software as a true dislocation in markets, one that is likely to be excessive. And the reason we can say that with some assurance is that the correlation of the sell off across every software maker, those that are going to have apps that will fill AI tools for people, is very real. It was a very severe correlated sell off, and the bounce back and some of the chop that we're seeing is quite correlated as well. You just take a look at the next page and think about software as an industry. You can see that year-to-year drop. This time, not associated with some massive collapse. It's not the trade worries that we had about recession in April of 2025. But you can see it really good there on the right, software relative to overall IT. This idea that we won't need software anymore, that you get it all free from AI, we think will probably be an exaggeration. Now, it's not to say that we're not going to have impact. And we may have impact from private companies, which means you don't necessarily get it in public markets. We understand that. But software is an industry that's capital light, that ever more of our life is involved in software, and that's why it has this secular trend of rising. So 4 times the S&P return over the last 35 years. It comes with 60% more volatility. We're not saying that you're going to be able to quadruple your S&P return in the next 3 decades, but we're looking at this as probably an exaggeration, and one of our principles of asset allocation is take advantage of dislocations.
That's right. And that's very important because whether or not the next 30 years are like the last, the fact of the matter is market overreactions to a sector leader are unusual and opportunities for us to actually step in to certain types of them. But I do think it is a question, Stephen, and you and I have talked extensively about this, about market leadership, because when you add up the spending, right, on AI and AI infrastructure at $4 trillion over the course of the next 4 years, right, it's an extraordinary amount to spend in one space, and it directly impacts, right, compute and the use of software, no question about it. But the fact is, we're talking about this great productivity tool, right, that is going to have a positive impact on the economy, and software industry is going to have to adapt associated with it, which is, again,
you see it on the next page.
Yeah, please.
And this is again a couple of things to consider. For one, cybersecurity. If you think about like what's being said here, this quote, I love this: Social Security's data breach could impact Americans for the rest of their lives. Right. This was again blamed on Doge, for example. But the whole point is that you're probably not going to say, well, ChatGPT, can you write me some cybersecurity software? You're probably not going to do that. So the need for cybersecurity software spending is going up in the economy. Winners and losers for the various stocks. Now the next page just shows what you talked about, David, which is the CapEx numbers. And, we are seeing remarkably strong CapEx numbers. That you see on the left is that 44% growth rate of computing power. What we've just seen in the earnings reports for the fourth quarter of last year is increased expectations for 2026. Now, if we went back 6 months, it showed the slowdown to a 10% growth rate. Then it was revised up to a 37% growth rate. Well, now it's been revised up to a 54% growth rate. Now, when we think about 3 years of rapid spending growth like that, we know companies are not doing this just because they love spending money ineffectively, right? You can get really punished for that. This is going to get to the level where we're going to have to use this in the economy. And there are questions about how far we're going to see a decline or a slowdown in chip spending thereafter. This makes it very difficult, again, but it gives us confidence that that part of the economy is going to be physically very strong in 2026. What we need to do, we think, though, in terms of our portfolios, is we have to invest beyond just the CapEx boom in AI and maybe the rebound that we see in software. What we wanted to do in our latest asset allocation, we'll talk more about it, is some areas that are laggers. Energy has been one of them. The oil price, with a potential trouble in the Middle East, is more than 50% below its 2008 peak. But energy infrastructure is a place where we have a lot of internal confidence that we're going to be able to get 8% yields. We normally don't use leverage in portfolios, but the leveraged mortgage REIT sector is going to give us double-digit yields. on a prospective basis with some diversification across the different types of mortgages. Now, that trailing yield doesn't quite show it that, but we're expecting to be able to invest at roughly an 11% yield with volatility in these areas. These are again, volatile assets. These are not treasury bonds per se. So the point on this, though, is that we can lock in what we think at a stable price will be an 11% return. And we have to do that when we take a look at assets that are really in boom bust cycles potentially.
Right. And I think it's important for all of our listeners to understand that, asset allocation is something you do 6 months or 9 months in advance. We've had 3 years of extraordinary investment. Stephen, you made a point that I want to reiterate to everyone, that the impact of these types of investments by the leading companies in the United States and the world when it comes to actually, making revenue, right, and charging for their services is telling you an extraordinary amount about what they expect the demand to be. And you also made the point that they're not doing this foolishly. They're doing this because they believe this is an extraordinary, once in potentially a 20 or 30-year opportunity for the leaders, right, like Microsoft and Amazon and others in the marketplace. So we take that very seriously. The impact that it will have on the economy, in terms of displacement of workers, in terms of efficiency, in terms of who wins and who loses in software, of course, yet to be seen. But this move toward MLPs and mortgage REITs for us speaks to the fact that, as Stephen said last year, the rate of growth at some point in this infrastructure will actually have to slow, and there will be a time, a lag or a lull, which will really make it possible for us to sort of benefit from the diversification that we're talking about today. Next slide. So with that, we want to talk a little bit about U.S. economic growth and its moderation. Now, it's very hard for the average person to say, well, GDP growth, America grew 3% a year, when so much of the growth is concentrated in one narrow sector of the economy. And last year, if you were to read our outlook in October, we talked about the fact that we thought that manufacturing, which had been held back all year by tariffs, was actually going to have a slight increase in its activity this year. So, Stephen, as we look back from February, which is not that far into 2026, how are we doing with that? And how is the consumer doing, all things considered?
So I don't think we're making much progress yet, despite the fact that the January employment report says we have. It showed the first gain in manufacturing employment since March of last year. And again, the tariffs came in roughly at that time. And all of the survey data said this is harming the ability of American companies to acquire the raw materials they need to produce more in the United States. Now, what you can see on the left, we took private employment here in this picture because it's better than what we saw in headline non-farm employment. There was the severe government shutdown, the worst in history, which affected fourth quarter employment data. But you could still see that with downward revisions, we have some negatives for private employment in 2025 overall. We're seeing gains in healthcare, non-cyclical industries, again, lead the pack. This is the reason why the Federal Reserve should be concerned, given their mandate of maximum employment, right, that perhaps we're in too weak a spot. They seem to be blaming weak immigration, which if you look at in isolation in the same survey data, seems also be distorted. Who wants to say, well, I'm out looking for a job and I wasn't born in the United States, to a census taker? This is one of those things. But what I'll tell you here is that the slowdown in employment and what you can see on the right has been on the weaker side for the consumption path for the U.S. That's not going to get you an economic boom. We do have a lot of restraint behind us, and if we simply don't repeat those restraints and we follow through on what we're seeing with mortgage rates coming down, construction activity that's too weak, production and trade that's just too weak even for this demand pace, we'll end up with a little bit better economy. But when you see the last 3 quarters, and I'm counting the fourth quarter's not reported yet, at over 4% growth, that's really about AI investment spending, right?
So
Which
can I
we
ask you a
showed
question?
booming earlier.
When we take a look at let's take a look at what happened in the bond market, Stephen. So if inflation is under control, right, in this environment, seems to be, right, and if you have employment data as we saw it, right, revised downward for last year, upward for the month of January, which is distorted. How do we understand, the 10-year rate today, and what do we look at? How do we think about the slope of the yield curve at this point?
Well, the Federal Reserve, whenever it eases, the yield curve steepens. We get to the point where the short-term rate over time is more volatile than the long-term rate. The long-term 10-year yield is averaging what short rates do over 10 years. And that is periods of restraint in monetary policy, periods of accommodation. It was only in that period around the pandemic that the Fed was able to convince everyone we're staying at zero forever. And then insanely, everyone took 0.5% and loaned the US government money at 0.5% for 10 years. Governments in Europe were setting policy rates at negative yields and penalizing positive yields. So these sorts of things. But most of the time, the yield curve is normal when the Federal Reserve is easing. Now, strangely here, what we've seen is people take out the expectation that the Federal Reserve will ease in the near term. Partly it's that strength of that January employment data, but I think you can see the market starting to say, well, wait a second, 2.6 million job losses converted
Right.
to 130,000 jobs after adjustment. Am I really going to believe this stuff? So the bond market is getting some comfort on the fact that, you know what, this isn't really here yet. The stronger economy beyond AI spending is not really here yet. But they also doubt that Chairman Powell is going to cut rates again before his term ends in May 15th. So they're putting the probability of rate cuts out there, presumably for the next Fed chair, which should be Kevin Warsh, and that should, under normal circumstances, take place in June of this year. I think we can wait a little on rate cuts. I don't think with the probability of a distorted consumer price index report that we're going to see in the month of February that they're going to ease as soon as March. But this Fed, in all likelihood, she'll still be positioned for delivering some rate cuts this year because of the weakness employment data, regardless of what happened in that January report.
Yeah, that's exactly right. That's exactly right. Let's go to the next slide. That's very important. Thank you so much. So we want to talk a little bit about what's been going on in our portfolios. First of all, we made a move probably now 4 weeks ago to increase our international diversification with all of the turmoil that was taking place. And in 2025, we saw a pretty extraordinary outperformance of international markets in dollars and actually in local currencies in some cases, many cases, for those portfolios. That was unusual because for the previous 14 years, the US had led the market. As we entered this year, there were doubts about whether or not international market leadership would continue and whether or not the US dollar was going to continue to suffer a lot of stress associated with changes and a lot of volatility or inconsistency in US foreign policy. Well, one of the things we decided at the very beginning of the year was to accelerate our increase in international exposure, which we have done. So we wanted to talk a little bit about this in several ways. One, about non-US equities, which we'll talk about in a second. Stephen will mention what we've done there, but also this other diversification into mortgage REITs, into MLPs, and our view that you get this diversification, the value of it, by moving earlier than you might otherwise think. You have to anticipate, right, where markets are going to go. So Stephen, you and I, probably make 3 or 4 moves in a year of significance. We've made 2 at the beginning of this year. How do you see it?
Well, look, would love to do them right together. What we saw going on with the U.S. sort of lashing out at allies again, we wanted to go quicker on the equity front. Now, if you take a look at the final page of the presentation, which is the next one to show our asset allocation, what we did is raise some of the high quality global dividend payers and high yielders. Again, companies in the healthcare sector with strong dividends outside of the United States, companies in some cyclical areas that have routinely increased their dividends. We made some benchmark upward adjustments to Japan. Didn't know that everything was going to go so well for Prime Minister in the diet, but Takeuchi in the diet. But things like that are really helping portfolios this year. There are some areas where cyclicals may be a little too strong. Some of what we're seeing in Latin America, given the news, might not be quite as sustainable for the jump up that we've seen in equities. We've decided to add a little bit more to the local EM bonds there as well. All of this is a hedge for the US dollar, which, despite the strong economic news, has still been on a downtrend. And if we're right that the Federal Reserve is not done with easing, we'll probably see more. So this is expressed in a variety of our emerging markets weightings in fixed income, in equity markets as well. And I'd say that if anything, we'd probably want to broaden that even further this year.
That's exactly right. And we don't talk much about what we did last year, but our portfolio, our level three, what we call moderate risk portfolio, which is about 62% equity and 38% fixed income, that portfolio almost equaled, right? The S&P return came close with a 38% bond weighting, and that was because of asset allocation. That was because of the fact that we saw the dollar doing what it was doing and build portfolios right accordingly.
Yeah,
As we
just
talk
about
about
half the volatility, a little over half the
that's
volatility.
Thank you for reminding me that, which is very good. So hats off to you and me. No, I'm joking, but that's what I'm saying. It's that kind of thinking that is part of our asset allocation, right? Our active asset allocation methodology, which I think is very, very important as we go through transitions. And when we think about the transition, Stephen, we're talking about an economy where we're literally building the railroads, right? The equivalent in this AI infrastructure. And as we get to the next part of our program today, we're going to speak with two experts, with Krishna Visvanathan from Crane VC, one of the leading venture capitalists in early stage activity, has been doing it for 26 years, which is actually 10 years less than I've done what I've done. But on the other hand, the world hasn't changed that much in my time. Aha. And then we have, of course, our own Abe Awanu, who is the head of client analytics for CIO Group and an expert in AI. And both of them are going to join us. Welcome, gentlemen.
Thank you, David. It's great to be here. Thank you for inviting me onto the show.
Pleasure.
Great to see you, David. As always, I'm always here.
That's exactly right. So we have Krishna sometimes here, Ebo is here. So welcome, both of you. I would love to ask you a couple of questions. Obviously, I'm going to start briefly with you, Krishna. So you talk a lot about, the value of early stage technology companies, right? When we build portfolios, we think about, going into the future, but we also think about this idea of hedging, right, in portfolios. Where do you see, the value of early stage investing, specifically in the areas, right, of software, in terms of portfolio design?
Yeah, I think when you look at public markets versus early stage investing, what, at least from our view, what we see in the current day and age is this disruption is happening in the market that generated by or driven by AI and innovations in AI, and you have this, I guess, this disconnect. Public markets tend to price, I guess, perfection price historically, and what we're looking at is investing towards future value creation, future value capture, and in particular, when we look at the agentic universe, you have this shift, and that's what we've been investing in, and I think that's perhaps how I would, represent the hedge, if you like.
That's
This
right.
transition.
You began investing in agentic AI. Looks based on, I'm looking at your portfolio, between 5 and 7 years ago.
Yes.
So it's good. So hopefully we'll find out if that works out well. So Abe, you get a chance to use agentic AI every day, right? You do it for CIO Group. If you don't mind, we can use ourselves as an example. But when you think about what you used to do when we worked together at Citi in terms of developing, let's say, a forward-looking recommendation for a client, right, which we used to call IDEA, and you look at what we're doing now at CIO Group, tell me how different it is to develop, to develop software and to actually deploy it in this environment.
So, David, it's night and day. It doesn't even come close to trying to describe what is the difference. So maybe I'll think about it from a workforce point of view, which is probably also why you're seeing such a decline in some of these software stocks, which I think there is very much an opportunity there. But thinking about it from the change in workforce, from what we used to do at Citigroup versus the way that we do it now at CIO Group, and it's not an exaggeration, one person is able to create the output of 65 people to over 100 people now with all things agentic AI. The workflows and all of the connectivity, the data, all of that is able to be processed at scale. The generation of output can be run in parallel. So just the sheer amount of scale that you're able to create with a single person, with an army of agents behind you, sounds like science fiction, but is very much the reality of what's happening today.
Krishna, can I ask you a question, which is, when we talk about, the equivalent of $3 or $4 trillion of infrastructure spending in energy, in data centers, and again, led by just a handful of companies, fewer than 10 companies are going to spend that amount of money. And Stephen said during our broadcast today that they're doing it with the intention of making a lot of profit for making those investments, right?
Yep.
What are they seeing? Why are they going to make a lot of profits? Is everyone going to have a subscription to them? Like, where's the money going to come from that goes
Yeah.
to them? Or who's leasing the data centers? Who's leasing the
Yeah.
chips? How does that work?
Yeah. I mean, at the highest level, I think about it as this transition from, if you think about conventional software or conventional value propositions, which were really fundamentally assistance driven, to a world where it's fully autonomous or largely autonomous. And when you have that transition, I think you can imagine how value shifts, and those that either power or own or control the autonomy narrative, whether that's people shipping chips, people building data centers, or the one that everyone I'm sure knows of, OpenAI and ChatGPT at the front end. These are the folks that will see, revenue streams, consumer spend or enterprise spend, if it's Anthropic, in the agentic world, transition towards, and that's
Right.
that's what I think they're betting on essentially.
So for those of us who don't understand all the language, right? What we're talking about is that what Abe was talking about, if you will, these agents, right? Things that are going on in the backdrop that are doing work for us all the time. Those are going to require compute power all the time.
Exactly, compute. Firstly, secondly, also storage, data storage and the ability to access that quickly in real time or in near real time. And then you have also paradigms that are starting to look at moving some of this stuff toward the edge, to the edge. So you get, again, better performance. And that requires, again, different sorts of infrastructure or different ways of thinking about how infrastructure is developed, deployed, architected, and operated, both hardware and software. I would say, or software in the modern sense rather than in the historical monolithic Oracle database sense, if that makes sense.
That's right. So when we think about that, Abe, in terms of the build out, right, of the platform, the other thing that I think people are not aware of is the ability to generate insights faster, to see in data sets information value that we had not seen before. Can you speak to that and to the difference between what Christian was talking about, which is the old model where the software, in a sense, did the same thing over and over again, but now, right, it actually has the chance to think, right, to take new data in that it's creating by its own activity.
Yep, that's a great point, David. It's a great question. So one of the things that we're seeing is that clearly the agents are able to work in the background. There's also these aspects where, and this is where a lot of the scale is coming in, is this whole notion of skills that you're able to give the agents. I like to think about this recent drop in software is obviously started with this I call it the 200 lines of markdown that Claude had released to the legal sector, just dropping everything. So it's trying to create that type of agency, that type of parallelization in the way that the agents are creating the data, working alongside us. That really makes a tremendous difference on how we're creating it. And then also by introducing those skills, you think about it's like you're hiring, as you like to say, 10 Stephen Whitings on the team,
I
right?
would do that if I
And
could do that. I'd hire 10 Krishnas too, and 10 of you,
so
frankly.
so and if you think about that, right, you're able to introduce just a tremendous level of variety and different levels of thought or chain of thought or debate into how the data is being processed and generated, and just being able to do even just that at scale, right? And also interjecting the domain knowledge of the human, that which is really, really critical. It's not that you're just letting these things run wild. It's that by interjecting, in our case, our intellect, our IP into the loop, is really what helps to constrain and ensure that there's no guardrails that's being broken. But by doing this all at scale and by having that variety of thought, you're able to generate insights that would have taken you a lot longer to get into, again, in the prior regimes.
The president. So, Krista, we're going to ask you two questions to end our broadcast today. So, if we were going to look out 5 years from today, knowing what the build is going to be, because we know what the infrastructure build is going to be, where does the threat come to NVIDIA, right? Can they be threatened by anything? Are they unstoppable by that? And what will be the things you invest in now that will benefit from the change in environment to the environment Abe just talked about with agentic agents doing workflows that go from an hour to a day to continuous? What will the world look like, and what will you invest in that world?
Yeah. So to your first question, I think your question succinctly is, will anything threaten NVIDIA? I mean, it's a phenomenal business. They have, obviously a stranglehold on the market today. But I think if you look back in time, every dominant player has at some point faced, new entrants, new competitors with a different approach, a different fundamental take to how to perform or deliver that value. And actually, as it happens, we have one such company in our portfolio, just announced in the Financial Times yesterday. A company called Olix published their manifesto on how they think about compute for the for the agentic age, especially inference derived compute. And I think I'm not suggesting that Olix, or there are a number of others in the market, and also you have the likes of AMD, playing in the space. I think I'm not suggesting NVIDIA will get dethroned or displaced in any shape or form, but I do think there are folks working on different approaches that will deliver better, hopefully, performance, depending on how one measures performance, throughput, cost.
Right. Well, people don't remember. I'll just interrupt you because people don't remember the history, right? There were 99, companies, right, in NVIDIA's area, as I recall, like working on graphics chips, right? And it wasn't clear, right? I mean, this is a man who bet the farm several times in his career and got it perfectly right? But it was the nature of what those chips could do at that time. And so now what you're talking about, and I want to just hear everyone hears it, is that it's not like this use case is going to be the same use case 5 years now either. It's going to require a different kind of compute.
Exactly. And that's a really important point, David. Today, the bulk of agentic AI is based on a particular type of algorithmic architecture, which is a transformer, an LLM. And there are a bunch of teams, including some in our portfolio that we've backed, that are trying to imagine the way AI can be performed, with architectures that are far more efficient, as an example. So that could be another way that one, doesn't threaten NVIDIA, but where value shifts to a different kind of modality, because the performance requirements is different.
Right. It also speaks to the issue of, like, again, lots of fiber was laid by lots of cable companies, and for a long time it lay dormant. It didn't generate much revenue, and then it changed the world, right? Then the internet changed the world. It took 20 years. This is not going to happen in 20 years, what we're talking about here.
No, exactly.
It's happening right now.
Exactly.
Right. So we will have the opportunity to work with Krishna on a variety of projects over the course of the next year. We're very proud to be affiliated with you and with Crane VC. You have no choice but to work with Abe for the next decade or two. I'm planning on it, which is great.
Likewise.
But if you haven't had a chance to use our wealth check, if you actually have not had a chance to see Agentic AI live and actually have your portfolio reviewed, we can take all of the data you have now, we can ingest it and provide you with insights that you seriously have not seen before about the performance of the portfolio, how it's positioned, and a lot of things like how much you're paying for it and how your cash is being managed instantaneously. In fact, what I'm going to do today is just to invite Krishna to put up his portfolio, which has got to be.
There you go.
I'm sure that we'll get a little bit of insight from that.
I'm sure you will. You might be shocked.
He's so busy thinking about the future that he's not thinking about his portfolio. We'll talk to him another time about that, which is great. So, Krishna, thank you for joining us. Abe, as always, I love working with you every single day and night. And guys, we'll be back next time. We look forward to more conversations on what's going to change the world. So thank you very much for coming today.
Thanks, David.
Thank you, Abe.
Thanks, Krishna.